Ladies and gentlemen, good day and welcome to Himatsingka Seide Limited Q4 and full year FY23 earnings conference call hosted by Elara Securities India Private Limited. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involves risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Prerna Junjunwala from Elara Securities India Private Limited. Thank you, and over to you.
Thank you, Renju. Good evening, everyone. On behalf of Elara Securities India Private Limited, I would like to welcome you all for 4Q and full year FY23 post-result conference call of Himatsingka Seide Limited. Today we have with us the senior management of the company, including Mr. Srikanth Himatsingka, the Managing Director and CEO, Mr. Dilip Panjwani, Executive Vice President and CFO Strategic Finance, Mr. Sivalai Senthilathan, Senior VP and CFO Manufacturing Operations, Ms. Shilpa Chanbag, Vice President Strategic Finance. I would now like to hand over the call to Mr. Srikanth Himatsingka for opening remarks and business update. Thank you, and over to you, sir.
Thank you very much, Shilpa. This time around, we are presuming that we've gone through the financials, so obviously these time down consolidated quarterly and FY financials. So we'd like to welcome all of you and thank you for taking the time today. I'm going to take you through a brief business update and then open the floor to questions. I think that'll be better in terms of giving more time to questions and answers. So on the business update front, our Q4 FY23 operating performance continued to demonstrate progressive improvement on the back of improved capacity utilization levels, softening raw material prices, and the marginal easing of energy costs. As a result of the above, capacity utilizations across our plants witnessed sequential improvement during the quarter. The capacity utilization levels for our manufacturing facilities stood at 98% for our spinning division. Sheeting division was at 61%, and the territile division was at 65% for the quarter. The revenues from brands for the quarter stood at 424 crores versus 548 crores during the same period last year. And for FY23, the revenues from brands came in at 1,713 crores versus 2,260 crores during FY22. We continue to see improvement on the demand front as our global clients have made significant progress optimizing inventory levels that in turn will facilitate improved order cycles. And key raw material prices continue to see gradual softening during the quarter. We've also successfully completed a fundraise of 560 crores from the International Finance Corporation, Washington, during the quarter, and this includes 100 crores of foreign currency convertible bonds. On the debt front, we continue to deleverage, and our net debt for Q4 FY23 stood at 2,587 crores versus 2,639 crores at the end of Q3 FY23. This was a short business update from our side, and I would just like to share some thoughts on the outlook before I open to Q&A. The last time we spoke, I did share with stakeholders that we are focused on progressive improvement starting the second half of the fiscal, and that's what we've seen during Q3 and Q4. And going into FY24, we see the same theme playing out during the year. We will be focused on clocking progressive improvement as we move through the fiscal. As we see things at this point, raw material prices have softened during Q4, and we think it will now be range bound, at these levels as we see it today. On the demand front, we are beginning to see an uptick in demand, which I believe will aid our progressive improvement through this fiscal. I now open the floor to Q&A. Please feel free to ask me any questions that you like.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Bhavin Chheda from Enam Holding. Please go ahead.
Congrats on a good quarter and showing turnaround with positive profits. So few questions. First, on the leverage side, you have raised money from IFC. If you can give us what's the average cost of that money. I think there's a FCCB component, so at what share price it is convertible. And your overall, I think net debt in the presentation stands at 2587 crores. So can you give us what's the average cost of the overall debt to give some guidance on the interest cost going into FY24 and also the repayment schedule of that debt?
So thank you, Bhavin. So the IFC, debt that we just raised and the FCCBs that we just raised are divided into two buckets. One is the NCDs that we placed, which is for about 460 crores, and 100 crores of FCCBs that we placed. The cost of the NCDs are comparable to current prevailing INR debt costs, and the FCCBs, as we had shared, in our disclosures, has a YTN of 4.5%. We have been conscious of making sure that the tenor is something that is long term, and the debt we have raised is 12-year money. So that's about IFC.
What will be the overall cost of debt, and is there any guidance on interest cost for next year?
Our overall cost of debt is in the vicinity of just under 10%, around that region, approximately 10%, and fluctuates because of floating interest rates. And as far as overall cost, interest costs are concerned, with our deleveraging sort of focus, we hope to bring that down a little. The second theme is, continued focused on working capital cycles, and we have reduced inventory during this fiscal by approximately 300 crores. We will continue to work on optimizing working capital cycles and the deleveraging piece that I just spoke about. So with these two objectives, we will, see our interest costs correct a little during the fiscal. We have not very much of principal repayments this year. I'd be happy to share that offline, but it's a very, very marginal number for FY24.
Sure. And my last one on the capacity utilization, you achieved decent improvement in quarter 4. So what's the trend looking like? Because from the other peers also who have already declared their results and given guidance, they are seeing very strong utilization. So you reported shipping division at 61 and dairy tower at 65 in quarter 4. So are you seeing a significant improvement there going into FY24?
Yes, I think we should make progress on that front as we go through the fiscal. I can't comment on what my peers have done, but as far as Himatsingka is concerned, we will continue to see improvement in utilization levels across our facilities going into 24.
Yeah, thanks a lot. I'll come back again for.
Thank you, Ravi. Yeah.
Thank you. Before we take the next question, a reminder to all the participants that you may press star and 1 to ask a question. Next question comes from the line of Bruce Mikosa from 9 Rays Equi-Research. Please go ahead.
Thank you for the opportunity. So I wanted to know, out of the total cotton we use, how much is imported, especially from US, and how much is procured domestically? Because internationally, US cotton prices have corrected sequentially over the last few months, but Indian cotton prices remain little sticky. We just wanted to understand this piece.
Unfortunately, Manish, it fluctuates from quarter to quarter depending on the product mix. But, you're right that U.S. cotton prices have corrected, Egyptian cotton prices have corrected, Indian cotton prices have softened as well. So I think all in all, we can't be specific about how much is U.S. cotton and how much is Indian cotton because it fluctuates. But I think we should stand to benefit on all three fronts progressively as we make our way through the fiscal.
Okay. A related question, sir. What kind of improvement we can expect in gross margins, keeping in line that cotton prices have come down in FY24 vis-a-vis FY23?
I think, hold on for a second. I think Q4 is a good we've made progress in terms of margins in the fourth quarter, and we should see some marginal improvement from here going into 24.
Okay. So my second question is related to the logistic or shipping costs, because last year this is one expense which has hit us, and especially also energy costs had shot up last year. How do these two expense items look in FY24, and how could that lead to a better improvement in FY24 vis-a-vis FY23?
So the supply chain costs have significantly cooled down. So there were three major buckets: raw material, energy, and supply chain. So supply chains cooled down significantly. It's largely factored in. Energy is not softened as much as we would have wished. That remain. It has definitely softened from its highs, but it's not corrected as much as raw material, for example. So we're going to be waiting and watching as to how the energy prices pan out. But we would see some benefit coming in from energy, and definitely from raw material, as we discussed.
We did 18% EBITDA margin in Q4, sir. So can we expect it to go to around 20% for the whole of FY24?
Unfortunately, I can't answer that question specifically. But I think, of course, there will be variations from quarter to quarter depending on product mix and things of that nature. We have spoken about the fact that our model generally should be in the region of 18 to 20%, 18 to 21%, somewhere there. Historically, that's what we've dropped. So there's some scope for improvement on that front. But then again, there could be fluctuations between quarters.
Thank you, sir. I'll come back in the queue.
Sure.
Thank you. Next question comes from the line of Manish Dhariwal from Fiducia Capital Advisors Private Limited. Please go ahead.
Am I audible?
Yes, Manish. Please go ahead.
Yeah. Thank you so much for this opportunity.
Thank you.
Mr. Himatsingka, I wanted to understand why is sales down Q on Q? Because we were actually moving up on the curve, on the improvement curve. So we actually see that Q4 sale is a little down compared to Q3. So could you help us understand that?
These are ordinary course fluctuations, Manish. Q3 is a little more seasonal than Q4 in our business. Sometimes it's spread between Q2 and Q3. Sometimes it's more Q2, depending on client preferences. Q4 tends to be a little soft, but as far as I see, we're in the region of 700 crores. We seem to be okay as I see it, and we seem to be in line for improving this further as we go into the fiscal.
Okay, as a follow-up, so how does the seasonality work in our business? You mentioned about Q2, Q3. Could you?
It's very simple. There's either in Q2 or in both Q2 and Q3, there is uptick because international markets prepare for Christmas. So there's some heightened buying and so on during those quarters. There's no definitive pattern, but that's broadly what we've observed. It could fluctuate. Yeah.
Okay, I get that. Secondly, now I noticed that our asset turnover ratios, which historically used to be around 2, are now kind of remaining at around 1. So going forward, meaning, is that a metric that you guys are kind of focusing on? Is it a matter of concern? Because improved asset turn will significantly improve your return ratios.
So basically, the asset turn was, took a little hit because, the capitalization of our backward integrated spinning plant, doesn't throw up any external revenues. So, including working capital, approximately over 800 crores, of assets were commissioned that were essentially for backward integration requirements. So that is what depressed the asset turn, but the benefits were, supposed to come through in the EBITDA, which is what was happening until we hit a volatile phase post-COVID, and we are now in the process of correcting that. Yeah.
Okay. So once that kind of situation corrects, then should we assume that our EBITDA margins, the range that you mentioned between 18 to 21, will kind of move up a little bit?
No, it should settle in that region, and we should, be able to deliver. We target rather to deliver ROCs in the region of 15%. So once our model sort of settles back in again.
Okay. And so our branded business, meaning what kind of differential in the margins it brings us vis-a-vis the other side of the business?
So I've been asked this question before, and it's a good question. It's difficult to pinpoint the margin differential that comes in through revenue, branded revenues. it's a couple hundred basis points at best because there are costs attached to brands, and sometimes it's neutral. I mean, it's at par with private label. But what it does do, and for us, is that it gives us better positioning, and it also gives us more revenue stickiness, if you will, from a standpoint of what we offer our global clients in terms of total home textile solutions. So it helps us be positioned better. It helps us give more value add, give a broader assortment of products, give a broader set of options to our global network of clients. It's the margin differential in the end is not necessarily significant. It could also be neutral.
Okay. Lastly,
so today, Himatsingka operates a bunch of international brands, Tommy Hilfiger and Kate Spade, and, Calvin, and Himatsingka leads the way on comprehensive and total traceability solutions in cotton, and we operate our own cotton brands and so on and so forth. So, the branded portfolio is not necessarily something that will make our numbers have an edge. It's more our positioning, our solutions, and our stickiness of revenue that's really the benefit. And we can be shuffling our brand portfolios from time to time, depending on the cost-benefit analysis of that brand.
Okay. I understand. So going forward, I think one of the challenge that we face is on the balance sheet, where our debt is significantly high, and the way we don't have control over the pricing on our finished goods, it might take us some time. Now, given that overhang that we have, and also you've diluted your equity a bit, say about 100 crore, so we do not know at what price that is going to get diluted at. So, what is your plan on future in terms of capacity enhancement and things like that?
Manish, so I understand your question, and let me throw some light on it. So, the good news is that Himatsingka is done with its capacity expansions over the last just prior to COVID, actually. And, we set up our new greenfield spinning plant, which was the world's largest under one roof. We set up amongst the 5 largest integrated terry towel plants. We completed our brownfield expansion in sheeting and enhanced our capacity to 61 million meters per annum. Our terry capacity stands at 25,000 tons per annum, and our spinning capacity stands at 211,584 spindles. All our assets are in place, and, this was something that we were going to sort of sweat. Unfortunately, we went through a phase post-COVID where the model saw a lot of volatility for 3 main reasons. One was COVID itself. It normalized after COVID, but then we were hit by hyperinflation on the raw material side, and then it followed by, a sudden dip in demand that transpired during FY23. So it was sort of 3 things in succession, back to back, which sort of took a toll on our operating performance. Now, the worst is behind us. We are sort of catching back up with our performance metrics and our model, and we are designed to be able to deliver, in the region of 4,000+ crores of output from the assets that we've commissioned. We've spoken about the kind of EBITDA margins that is possible to achieve, and we have been achieving in the past. So, the math is pretty obvious. And once you look at it from that lens, as far as our leverage ratios are concerned, there's no doubt about the fact that it's currently high. I've been very transparent on that front with stakeholders. This is not where we want to be. But historically, up until this volatile period, we had basically two essential metrics that we made sure we adhered to. One was our net debt to EBITDA was something that we'd like to maintain at 3.5 times or lower, and our DSCRs used to hover in the region of 1.8 to 2.2. So we endeavor to get back to that level as we progress. From June 22, we were at debt levels which were substantially higher. We've corrected gross debt by about 300 crores since June. We continue to correct it in Q4. So on the one hand, the EBITDA will improve. On the other hand, our debt will reduce, and that's what will cause the leverage ratios to correct.
Thank you. Mr. Dhaliwal, we request that you return to the question queue for follow-up questions. Next question comes from the line of Dhananjay Bagrodia from Ask. Please go ahead.
Hi, sir. Maybe I missed this earlier, but this is just a little bit on the final product. How is the demand in each of the countries, and how are we seeing that now? Because we see Target had a $500 million loss, inventory loss. So how is their demand coming along, and other players along in the US?
That might be a client-centric development. Generally, we are seeing reasonable improvement in appetite as far as demand is concerned. The FY23 was pretty dismal on the demand front, and we've all shared with you why and the reasons for the low demand during the year. But now we are seeing appetite come back, and as I was telling somebody earlier, as we go through the fiscal, we think that there will be improvement on this front.
Okay.
There could be buckets, where you read news items or occurrences that might suggest something else. But if I look at it thematically, it seems to be in a much better position than what we saw in FY23.
Nice. So would any particular regions which are showing better demand?
Yeah, because fundamentally there was a lot of inventory correction that was taking place. These are the clients. They were overstocked. They needed to correct their weeks of supply, and this was something that we saw industry-wide. And that was the most important of all the reasons that caused the dip in demand. That's largely sort of done and dusted. It could be still going on in some pockets, but again, from a macro standpoint, it's an initiative that's been on for pretty much the whole fiscal, and hopefully this is not something that's on the table anymore because it's largely done. And then there could be other reasons which are region-centric or client-centric, but I think this was a primary reason. There was also a sense of caution in the air, in terms of wait and watch and let's see how things unfold and so on. But I think, as I was saying, we do see reasonable improvement in appetite. But it's not just that. As a company, we are focused on tapping new channels, new clients, broadening our product mix and the assortments that we offer. So it's not just waiting for the appetite to improve. We are also making proactive efforts to place more, to get more market share, and to basically, tap markets and regions and clients in a more holistic way. So that's an effort that continues to sort of unfold. The commissioning of our Territal plant also gives us access to a whole host of new clients. We've been fairly satisfied with the addition of new clients that we have done over the last couple of years. And so all of these things also have to be kept in mind when looking at, the uptick in revenue streams that we expect.
Okay. And lastly, would there be any supply disruptions or any supply problems with any other geographies in terms of any other countries having any issues, or are we going to see growth as broad-based for all countries together?
I mean, things could crop up.
At the moment, nothing of that sort, right?
Nothing on our radar at this point, yes.
Okay, fine. Sure. Thank you so much.
Thank you.
Thank you. Next question comes from the line of Riya Mehta from Equitas Investments. Please go ahead.
Congratulations on good set of results, and thank you for giving an opportunity. My first question is in regard to how is the demand scenario in like China, Pakistan, Vietnam, and Bangladesh? What is the global scenario?
Thank you for your question, Riya. As far as we are concerned, Asia Pacific has not been a very large market for us because of the nature of fragmentation. Although we made a lot of inroads over the last couple of years, but Asia Pacific, has other, let's say, developments which are of relevance to us, right? We've all been talking about the China plus one sort of theme that seems to be playing out. My own observation is that as far as our industry is concerned, and as I see it, it seems to be becoming a little more intense. This whole China plus one thing, as in there seems to be a lot of migration opportunities in store, and a lot of it's been activated in various stages. So that's a theme that's playing out. It is real. It remains to be seen how much one can capture, but it is real. The other theme that's playing out of late is, the opportunity that India stands to tap, given the issues and challenges faced by Pakistan. That's something else that cropped up on the radar of late, and that seems to be a macro theme / opportunity that one should keep in mind. It may or may not translate to specifics, but it's just something to share. And, so I would say these two things are very important when it comes to considering medium-term opportunities in this space. The demand side, as I was just sharing with somebody, that there seems to be a reasonable improvement in demand starting the second half of the fiscal, and the main reasons that caused the demand to dip, which was essentially inventory corrections and so on, that transpired during FY23, that seems to be largely sort of concluded, and we see appetite coming back. There could be exceptions, these are client-specific exceptions. There could be some regional, sub-region specific exceptions, but thematically we see improvement in appetite.
Got it. And my second question is in regards to the cotton crop in India. So, per se, the estimates which were made, the production has been lower, stagnant because of the rains and all this. So how is the crop panning out, and what would you guide for the prices going forward, since the crop is not inadequate, lower than estimated?
As I said earlier, the crop estimates will continue to be subject to change. But regardless of what the crop size is estimated to be, Q4 saw some marginal softening of raw material prices of Indian cotton. And as we currently see things, it should be range bound here. We shouldn't see volatile fluctuations. At least we have no reason to believe so. Things could crop up, as we all understand in today's environment. Is not everything that one can predict, but we see it to be range bound at this point. Of course, we'll circle back shortly next quarter and share what our observations are then, but this is how we look at it right now.
How much will be the inventory levels for how many months inventory will we be having right now for cotton?
Not very much. Under maybe it fluctuates, but maybe About less than a month.
Okay. And even for the imported cotton, it is only less 1 month kind of an inventory we keep?
No, I mean, I'm just giving you what's at the plant. There could be pipelines, and so on, and bookings. But yeah, physically, we don't see any need to keep more than that.
And how many months before do we contract for the cotton?
There is no specific methodology we follow. It depends on varieties of cotton. It depends on a host of factors. But it could range from very short periods to relatively long periods, and taking calls for maybe 6 months. But again, that's subjective and depends on several nuances.
Okay. My second question is in regards to the finance cost for the current quarter. We've seen, I think, 48 crores versus 70 plus crores earlier. So what has led to this dip, and what kind of finance cost do we foresee going forward, because we are not repaying any significant debt going forward? So your inputs on that.
Yeah, there was some, which I had shared during the last call. I was asked about, some subsidies that we did get on interest, and for a brief, period of 3 quarters, that subsidy had ceased, to be something that we were taking. But I did mention that we will shortly be resuming to get some subsidies on that front, which has been the case over the years. So that's what has resumed, and there were some benefits accruing out of that during the quarter.
So that would be sustainable, right? Those benefits?
Yeah. But, we have a current net debt of about 22,582 crores, 2,587 crores. Average cost of debt is in the region of 10%. I think for you to compute your interest costs, do bear that in mind. And then from there, there will be some additions of charges and reductions of some subsidies.
Okay, there will be further reduction of subsidies going forward from next quarter.
No. So how one has to just sort of piece the puzzle is that you have, your debt and an average cost of 10%, and that one would have to add, I guess, regular, charges, interest and bank charges and so on, which, and then you have to subtract the subsidies. So I think that's how you should be computing it.
So these subsidies would be for a long period of time, or what is the basis of these subsidies? Could you just elaborate?
Yeah, we should assume that to be around for the next couple of years, and then we'll have to take a fresh look at it.
Okay. I think that's it from my side. I'll join the queue for further questions.
Thank you. Before we take the next question, a reminder to all the participants that you may press star and 1 to ask a question. Next question comes from the line of Surya Narayan from Sunidhi Securities. Please go ahead.
Yeah, thank you for giving me opportunity, sir. Just want to understand if you can quantify the average realization of your seed this year versus last year.
Yes, this fluctuates, so it's difficult to if you were to base your model on that. I understand where you're coming from, but let's have a chat offline so that I can explain how the model works for your assumptions and computations. But an average realization, I can't be specific about it.
Okay. So another point is that now how much in our fiber, how much is imported and how much is domestic? And apart from cotton, are we also dealing, I believe for upholstery items, we could be dealing with some other, man-made fibers. So if you can quantify in terms of percentage, what is that?
So it's largely cotton. Our upholstery division is a very small division. So even if it does use other fibers, it wouldn't really add up to much. So cotton would be in the high 90s in terms of percentage.
So out of that import content is how much, sir?
It keeps fluctuating. So there's no set percentage. There could be a quarter when it's low, and then there could be a quarter where it's high. So it's difficult for us to pinpoint how much is imported. But I think what one can do is focus on the overall gross margin of the business, regardless of the type of cotton.
Okay. And sir, if you, let's say, rate your expectation of, let's say, US inventory, the store level inventory at, let's say, 100 level, so to what extent it has corrected, till date? We are hearing that it has corrected significantly and it has given a rise to some kind of uptick in demand in the second half of last year. So is it still going on, or again it will subside?
No, it's not going on anymore. In fact, there was a correction going on.
Yeah, that is what correction only I'm asking.
So the correction is largely over at this point.
Okay.
See, there could be exceptions which are client specific, but thematically, whatever had to be reduced has largely been achieved at this point. They could reconsider their stance, want to do more, but to the best of our knowledge, it's in the last stages of completion.
So, traditionally, Pakistan has been a very efficient sheet makers, and also their cotton quality is better than us. So, in that light, how much they are efficient than us in terms of cross margin, or any idea that how much they are efficient? A. Number two, due to the crisis that is currently in the Pakistan, have you received any new orders from any new customers due to that?
So, to the first, it'll be difficult for us to quantify efficiency of Pakistan, right? It'll be difficult. And had essentially two advantages playing out, largely speaking. They had a currency which was depreciating, let's just say at unreasonably fast levels because of the situation, I guess. And the second was that they have preferential access to several jurisdictions, in terms of duties. So these are the two things, that made them attractive for certain, clients. Now because of the challenges that are playing out in that region, we have received inquiries, and we've also received orders that were formerly being done in Pakistan and are now being shifted to India.
Okay. And sir, regarding your other FTA issues, if suppose FTA were to be signed in July, what we are hearing from industry people, from UK and Canada, and later on from the EU, because we can see some kind of bargain from the parties, because they are facing issues due to the inflation issues. So are we going to cede some kind of or sacrifice some kind of margin, and because they will obviously be pinpointing that we will be at an advantage level of to the tune of around 10 to 11%. So how we are getting how you see that scenario?
It's very simple. The day, look, if we sign FTAs with jurisdictions like Australia, all of these zones and jurisdictions, it may not sort of result in significant movements. But if we were to look at, jurisdictions like UK and the EU, and if that's something that India does manage to push through, there's a very strong case for the buying side to consider India for obvious advantages that they'll get.
So in that case, will they ask for any sort of bargain you foresee?
Yeah, they could. I don't put it past them. I think it's something that they might request for, but it will still be an added opportunity and incremental business and with incremental margins.
So if that be the case, then what is our position vis-a-vis at least for, let's say, Pakistan or Bangladesh, considering the 10% advantage that we will be getting? So what is the parity we are with, let's say, Pakistan and Bangladesh?
No, so, even in recent situations, there's been dialogue and they've challenged India on pricing, and India has risen to the occasion. We look at this in the medium term. We don't look at everything short term. And I think, as speaking from a standpoint of Himatsingka, we are ready and capable. There could be a couple of opportunities we reject, but then there will be several that we'll accept. So all in all, I think it will be a gain, and I think we are ready to play.
Okay. And sir, apart from the cotton side, other raw material prices, chemical and other processes, how those inflation has been? Has it corrected also, or is it on the higher side still?
Well, as I said earlier, cotton's corrected from its highs. We saw some corrections happen in Q4 as well, but I think from now it will be range bound. It's difficult to predict the commodity beyond a point. As far as dyes and chemicals and things like that is concerned, it's been largely stable over the last few months as we see it. And as far as energy is concerned, there's been a marginal softening. It could have been a little better than that, but it's marginal at this point. And supply chain has corrected significantly.
Okay, sir. Thank you, sir.
Thank you.
Thank you. Next question is from the line of Rishikesh Oza from RoboCapital. Please go ahead.
Hi, sir. Thank you for the opportunity. So my question is, one company, Bed Bath & Beyond, they have filed for bankruptcy. So do we have any receivables from there?
No, we do not. And we have reduced our exposure even during the fiscal significantly, so it won't have any material impact on us from a revenue standpoint or a receivable standpoint.
Okay. So my second question is just with respect to the revenues. So so with the current improvement, fair to say by Q1 or Q2 we can go back to our 800 crores of quarterly run rate.
I unfortunately can't specifically outline that number for you, but as I was sharing with everybody, we are focused on. We are currently in the 700 to 750 range, and we are going to run for progressive improvement from here. So I think I think you should keep that in mind while building your model, and if that's the case, then we should sort of keep seeing improvement from these levels. There could be fluctuation sometimes between quarters, but generally speaking, we should sort of ride on the improvement on the demand front that we are seeing.
Okay, and so just one final question. In current quarter, we are seeing interest cost of around 48 crores. So can we expect this cost to be to continue for the future quarters too?
No, as I was just sharing, we can't assume this cost because the way you should compute it is, I mean, you should just you should maybe look at in the region of probably 70 crores, thereabouts, 65, 70 crores, plus minus.
Okay. Okay. Per quarter. Okay. That was it. Thank you.
Thank you.
Thank you. Ladies and gentlemen, we have reached the end of question and answer session. I would now like to hand the conference over to the management for closing comments.
As always, it's such a pleasure to have interacted with all of you. I do hope I answered most of your questions. If you have anything further to ask and to clarify, to get in touch, and we'll be happy to take you through your queries to the best of our ability. Thank you once again for taking the time. Thank you.
Thank you. On behalf of Securities India Private Limited, that concludes this conference. Thank you for joining us. You may now disconnect your line.